We now move on to a thought leadership presentation. It's actually from Alan Gelder. Alan Gelder is the Vice President for Refining, Chemicals and Oil Markets for Downstream for Wood Mackenzie. And he's going to be talking he's going to be talking about sustainable refining through the energy transition, key characteristics of the sites well positioned to adapt to the energy transition. We haven't talked so much about energy transition as yet, but we're now moving on to this towards sort of the second part of the day. So over to you, Alan.
Thank you, Adam. Hello, everyone. I'm Alan Gelder, VP of Refining, Chemicals and Oils Markets for Wood Mackenzie. It's a privilege to share with you our high-level thoughts on the topics of refiner sustainability through the energy transition. Refiners have had a bit of a roller coaster ride over the last few years as their market environment has been transformed since the pandemic. Let me explain these charts. So what we're showing here are charts of composite refining margins. The shaded blue area is the historical 5-year range. The dark blue line is the 5-year average, with 2021 shown as light blue across both. And then we're showing sort of 2022 and 2023 our projections in the chart on the right hand side. So if we look back to 2020 was effectively setting the bottom of that 5-year range. So during the summer of 2020, so it was the peak of the pandemic, the gross product, the refinery gross margin was zero, often negative. And that was because the value of the products were equal to or less than the value of the feedstock, and that was without refinery operating costs. So under that situation, that led to global capacity rationalization of around 3 million barrels a day. Since the depths of the pandemic, demand has grown quite strongly. Refining margins have recovered, but then you can see in the light blue lines, where at the end of 2021, the gross refining margins are near the top of the 5-year range. But then what we've seen over recent months is a spike in margins, really driven by the Russia-Ukraine crisis and the acknowledgement or the fear that distillates will become in very, very short supply. So prior to the Russia-Ukraine conflict, global stocks of gasoline and diesel gas oil were very, very low. The conflict has led to the realization that the stocks are too low and prices, particularly for distillates, primarily diesel, has surged. We think the refining system is entering a period where it's going to be distillate-led, and as you can see from the margin chart on the right hand side, that prevails for quite some time, with 2022 refining margins being very high compared to history, and 2023 being more normal, but still at the top of the range. Now, the issue, and many Europeans will acknowledge this, is not everybody is benefiting from this, because Europe is exposed to high natural gas costs and also high emissions costs that a number of the other regions are not experiencing. But 2022 clearly shows that refineries are expecting to have a fairly successful year commercially. The question is how long will this last? So we show this on these two charts here, and here what we're showing is effectively our oil demand growth on a global level. And if you look at the chart on the left hand side, the actual global liquids demand is that light blue area. And that says we recover from the pandemic, the pace of recovery then slows, but oil demand continues to grow to reach about 108 million barrels a day by 2034, and then starts to fall away. That rate of growth, that's annual increase, is much smaller than history, and that's because what we're seeing and what we're expecting is the displacement of oil by other energy sources to grow as a result of the energy transition. The energy transition is really looking at the decarbonization of the transport system, and that's what you can see in the dark blue area, where we've got growing penetration of electric vehicles in passenger cars, but also light and medium duty trucks in the dark blue. In the grey, it's about LNG, and that's primarily in marine and also into heavy duty trucking, and then some fuel cell vehicles at the end, which is more around heavy duty trucks towards the end of the forecast period. So what we have is the energy transition takes hold. This is not compatible with a 1.5 degree C world, but it does show that oil demand globally will start to fall, which is a challenge for refiners. If you look at the chart on the right hand side, there's a distinction between oil that is used for energy, that dark blue, and oil that has some non-energy uses, which is the light blue. So oil in energy use peaks in 2027 and starts to fall. Non-energy use, we expect that to continue to grow, and that's primarily oil for petrochemical feedstocks. Now, so the outlook for the energy transition is petrochemical feedstock demand grows, but is unable to fully compensate for the decline in transportation. So we need to think about what this means for the refining sector. But we've seen that already, and we've seen that effectively in the pandemic. So this chart shows the demand profile relative to 2019 as we've gone through the pandemic. So everything's based on the relevant quarter for 2019, and we're showing the impact on product demand on a quarter by quarter basis by product. You can see the products where demand was hit hardest are those that involve personal mobility, which is gasoline and jet fuel. Diesel gas oil for manufacture and movements of goods was hit hard initially during Q2, but then less hard as we went through, and you can see 2021, that total line is getting close to 2019 levels, and by the end of 2022, oil demand we're expecting to be greater than that corresponding period in 2019, so above pre-pandemic. But the important thing is actually the light blue area, which is that LPG and naphtha, has continued to grow and shown growth even while transportation fuel demand is falling. So 2020 does give us a glimpse to the future. You could argue the difference is jet fuel, in that we think in the future jet fuel demand remains reasonably robust because the need for long haul transport, whereas it got hit quite hard during the pandemic. But then there's also provides some context for this opportunity for sustainable aviation fuel. So if 2020 was a comparison for oil demand, for the future of oil demand, we need to think about what that did to the refining industry. Now, we've already explained that gross refining margins were very poor in 2020, and if they weren't great throughout the whole year. And what this is showing is our assessment of site profitability for the European refiners on a net cash margin basis, which is cash after cash, cash margins. So it's taking gross margins, taking off variable costs, and taking off fixed costs. And what we've done, and for each of those sites, that the subscribers, they'll be able to identify who they are because we name them. We've just simply coloured them between those that are petrochemical integrated, so the light blue, and those that are standalone fuel sites that are dark blue. Key thing here is less than a quarter of Europe's sites were cash positive in 2020. There were the vast majority of the sites that were materially cash negative were the standalone fuel sites, and it's this type of performance that led to the extensive rationalisation that we experienced. But this leads us to a thesis that says for the refiners that are best placed to adapt to the energy transition, we probably know who they are. And we believe it is those heavily integrated refinery chemical sites, because they remained cash positive during a period of falling oil demand and strong petrochemical demand. They managed to generate positive cash flows, positive margins. That enables them to invest, to adapt. It also enables them to fund, to provide some returns to their shareholders. So we think it's these integrated refinery chemical sites will be the ones that are best placed to adapt to the energy transition as we go through. So we need to think about what they need to adapt and how they're going to adapt. This chart is just showing overall global emissions, and you can see that the vast majority of global emissions are for the transportation sector, scope 3, the combustion of the fuels, and then also industry, and we split out refining. So if we're going to address overall global emissions, there's the grey area, the power sector, that's wind and solar. For transport, a lot of it is about electrification, but it also highlights the opportunity to decarbonize those hard to electrify sectors that are heavy duty trucking and sustainable aviation fuel. But the refining sector itself at 3% of emissions cannot be forgotten. But we don't have an even distribution of where those emissions are coming from. Almost half of the emissions, just over 40% of those emissions, are from Asia Pacific, and that's because of that's where a large part of the global refining system is. They're complex refineries, so they're energy intensive, and also they tend to use high carbon fuels, both liquids and in China, also coal. So how do we decarbonize the refining sector? If we actually looked at where those emissions come from, the vast majority of the emissions associated with the refining sector are from combustion. This is providing the energy that's needed to undertake the chemical transformation that is happening at those sites. It's also providing the energy that's needed to separate the products that come out from those chemical conversions. That is the vast majority of the energy consumed by the refinery and the source of those emissions. There's power that's generated, but also hydrogen. So if the refining system only focuses on the production of green hydrogen, there's a big opportunity that's being missed. If we're going to decarbonize the combustion, there's the need for carbon sequestration and storage for those high carbon fuels that are being consumed, but there's also a greater opportunity for green hydrogen in displacing some of those fuels within the combustion process. So the opportunity for decarbonizing refineries, it goes far beyond just the decarbonization of the hydrogen that's needed for the chemical processes that we're showing here. So if people are going to invest in decarbonization and try and adapt, what they're aiming to do is move themselves into the target quadrant that we've identified here, because we need these sites to be both commercially and environmentally competitive. And what we're doing here is showing cash margins on the x-axis and emissions intensity on the y. The sites that we think are best placed to survive and adapt are those in the target quadrants. For the other quadrants, we've identified what we think are the key actions that the owners will need to consider to get into that target quadrant, be it reduce emissions for those sites that are competitive but relatively high emissions, be it to invest to become more competitive for those that are competitively weak, but also it identifies a number of sites that we think arguably owners should divest or should consider closure given the scale of the investment and the change that is needed. And that's because really if we simplify the refining industry and we think about the owners, they're all operating existing assets. There's two extremes for them to consider. There is, what do I do with an existing asset? One is to run for positive cash flow if the site is currently cash positive, which means business as usual, so focusing on improving efficiency, margin capture through digitalization, cost excellence. But ultimately, the site will be closed or converted into a biosite. For those sites that we think are sustainable, take the existing ones and they need to be invested in. Depending where they are determines the degree of investment, but it's certainly where they need to be is first quartile integrated refinery petrochemical sites that are a key part of the energy transition. So that means they're upgrading fuels, feedstocks into primarily petrochemicals. There's little fuels production. That fuels that is produced, the secure offtake for, and those fuels that are produced, a large part of them involve liquid renewables, and the operations are decarbonized. There's a huge opportunity for the refining sector to maintain its role as a key part of the transformation business, but what it needs to do is to switch what it's transforming from crude oil to other renewables, agricultural feedstocks, and become a key part of the circular economy. With that, I'd like to thank you for your attention and hand over for some questions.
Thank you very much, Alan. That was fascinating. I think we talked a lot yesterday, especially in the afternoon, with some of the companies about circularity and low carbon solutions. And there was a big discussion about locations and what's good and what's not. Blue hydrogen, green hydrogen. I mean, I think we went through the whole cycle yesterday. So, but that was really, really impressive, and it was really good how you distinguish between the level of oil, what it's used for, what goes up and what goes down. I think that's really interesting reading. Obviously, we'll talk about the conflict, what's happening with Russia, Ukraine, the awful situation that's going on there. What are the near and medium effects and uncertainties that sort of affect now the downstream sector for this?
Well, there are a number of things that have happened that we just wouldn't foreseen. So I think you have to expect the unexpected, because we wouldn't have expected a few months ago, before this conflict, that Russia would have cut off gas supplies into Poland and Bulgaria. And so the situation's evolving every day. And what you've got is companies and countries introducing sanctions on Russian energy flows. That has an implication on overall sort of energy supply and energy balances. So we're seeing sort of we're seeing high volatility in both oil price and diesel price, and a large risk premium for people to be incentivized to take it, which is just giving sort of a lot of high margins for European refiners, which they're enjoying, but lots of uncertainty around the sustainability, because does this result in economic weakness and economic downturn? And then if you think longer term, could we be going into a world, well, will our trading relationship with Russia ever revert back to what we had a few years ago? What will happen to European energy costs? They're likely to be higher. We've got the aspiration for European Union to sort of accelerate the transition when it can, but what comes with the funding? So there's lots and lots of things that are very unclear as a result of this conflict, and the only sort of certainty we seem to have at the moment is it's not going to end quickly. So it poses a real challenge to decision makers on what to do next.
It's a big issue at the moment. I mean, there's so many things that get hit right across the value chain. I think we won't see the impact of that, I think, until even another few weeks, another few months, because as you said, new things will come up every day and something else will happen. It will affect the price of this. And look now what's happening with gas, oil, electricity. I mean, it's just incredible, the state of affairs. So how strong is the threat of refinery closure of the next few years?
Subject to we're not going into a major economic downturn, then actually we think the threat of closures is quite low. And that's because a lot of sites that were sort of competitively weak got cleared out by the pandemic, because that sort of really hit demand, and we lost 3 million barrels a day of capacity. If we think forward the next 8-10 years, then on our current view of sort of economic growth and sort of oil demand, that demand growth for refined products is very similar to the capacity additions we're expecting on refining capacity. So that seems quite balanced. So if we go back a couple of years, we would have been saying, give it a year or two, and there's going to be big refinery additions, that means Europeans will be under threat of closure. We just actually don't see that now. So this isn't something that we've seen for quite some time. So no doubt there are refiners that are sort of financially challenged, but we're not expecting a big slug of capacity to come on and prompt closures elsewhere, subject to us not having a good old-fashioned recession. That's not our base case. So with that, we kind of think the risk is, could be famous last words, but the risk is low.
It's good to hear, because I think when I had the same or similar conversation with you in the last event we did, I think we did it in March last year, so it was a little bit earlier, and obviously it was pandemic time, and I think it was very, very much doom and gloom with everything. So it's really good to see a different sort of viewpoint from you now, and what's happening. Finally, or one last question I want to ask you, because obviously we talk about closures, but what are the characteristics of the key sites at risk of future closure or conversion to biosites?
Now, the conversion to the biosite, I mean, the classic one, what are the characteristics of the key sites at risk? It's the ones that are competitively weak, they're fuels only, limited petrochemical integration, they're relatively small, they're relatively simple. But what we've seen is sites that, and typically they're losing significant, they're sort of negative margins and losing significant amounts of money. Those are the ones that are at risk when the owners suddenly realise actually the world's not going to change. But what we've seen, and we saw it during the pandemic, and it's part of the reasons for the rationalisation, is actually converting refineries like that, very sort of poor margins, converting to a biosite actually can be much more valuable, because the sites that are producing hydrogenation vegetable oil or sustainable aviation fuel, that can be commercially quite attractive. Okay, the scale is much smaller, but it's a much smaller scale and is cash positive, so it's kind of rateable compared to something that's bigger and much more volatile. So it doesn't actually need the refineries, and we've seen this in the US, the refineries to be losing money. It's just there may be a better opportunity to convert some of those sites into biosites, because you can reuse some of the equipment, so the capital costs aren't so high. So this energy transition and the need for low carbon liquids in hard to electrify sectors, that may well prompt conversion of a number of relatively simple, competitively weak refining sites before they start to lose significant amounts of money. So that's a bit of a new dynamic that's appeared over the last year or two. Concern now is effectively, again, it comes down to impact of Russia, Ukraine, impact of vegetable oil prices and those feedstocks. It's food versus fuel is starting to come back. So that's never a good place for those people who want to process vegetable oils for fuel, if people actually want to consume it as food.
It's interesting how it's going to pan out. Well, hopefully we'll see the end to this, and we'll see a bit of stability as well in the market, which I think we all need to see that as well. So
that would be much appreciated, a bit of stability. If all these huge price swings every week, every day.
Yeah, it doesn't do anyone any good. But look, Alan, we made it. We made it through some questions. So no, I'm delighted we did that. I think your presentation was excellent. I think it's, you're seen as a bit of a barometer on these areas as well. So I think a lot of the audience will appreciate the information you shared, not just with your presentation, but also now with the Q&A. So thank you very much for joining me, Alan. And I actually look forward to having you later on the final panel of the day on sustainability. So I will see you over there. Also, if you want to get in contact with Alan, please contact him directly. Or if you wish to obviously have an introduction, please go to me as well.